Should you ask your employer to take more tax off your paycheck? Maybe, maybe not. Ian Martin is here. We'll discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
According to my cue card here, Ian Martin has both a bachelor's and a master's degree from the University of Waterloo. He's a chartered professional accountant, a CPA. He spent 2 years working in industry. He's been a licensed insolvency trustee working here at Hoyes, Michaelis and Kitchener for 12 years. Is that true?
It is.
But of course, we ignore all of those expert qualifications and have him on the podcast because of the 6 years he spent toiling away at Canada Revenue Agency. So Ian, welcome back. You ready to talk tax?
I am, Doug. Having said that, I mean, given the time of year, I would rather sit around and talk about baseball.
I understand, but we don't have time. We got to get to the issue at hand.
All right.
So the question today is, it sounds like a real simple question. Should I ask my employer to take more tax off my paycheck? And every financial planner will say, yeah, sure. So there you go. That's the podcast. Thanks for coming out. Debt free in 30 seconds. But there's more to the question than that, because by taking less tax off, you get a bigger paycheck. But if you take more tax off, then you're going to owe less next year. So
or maybe a refund.
Yeah. So, okay, let's start with the basics and kind of build up to what the correct answer is. And I'll give everyone a spoiler alert. The correct answer depends on you, not what we think, because everyone's situation is different.
Exactly.
So first question, why does an employer take tax off my check?
Simple answer, they are required to by law. I know when I was preparing for the show, I was thinking about my teenage son.
You did show prep?
Well, it was like
awesome.
Maybe
that is awesome.
2 minutes or so.
Show prep. So
right. So my teenage son, got his first job last year. And of course, he's dreaming of how he's going to spend his money. He knows the hours that he's worked and his hourly wage, and is kind of surprised when he sees the deposit in his bank account. It's a little bit less than he expected. Mm-hmm. So we review the pay stub together, and he says, "Dad, what's this? What's this tax at EI and CPP?" And I tried to break it to him, gently about what it is and the social benefits to those things. And I didn't have the heart to do the math and say to him, for the next 30, 40 years that you're working is, the hundreds of thousands of dollars that is going to add up to. But
and so he is a teenager, I assume. What, like off the top of your head, what percentage came off his check if you added up EI, CPP, and tax?
Well, that's a tough one, Doug, because I don't remember the exact answer to that question. And it was relatively low.
So like 10, 20%, something like that?
Yeah, it would. I think it was under 10%, because there's certain percentages with EI and CPP that, honestly, the exact number escapes me. They're relatively low. But the income tax portion was lower than, say, as a student working part-time, it was a lower percentage than somebody who's working full-time at a higher rate than what he was earning, because that person, not my son, that is, they're going to owe more tax. So
Right.
So the employer is trying to basically predict how much tax does this person have to pay in the year and take it off in little slices throughout the year so that you don't owe money at the end of the year.
And that's what the employer is doing. So I am an employer, and it's all done by computer.
Yeah.
I assume there's some big table or something that figures it all out. What goes into that calculation, though? So what are the things that would cause my employer to be taking more or less tax off other than the amount of money I'm earning?
Right. And I guess there are different pieces to that. I know sometimes when I'm meeting with clients, they'll say, "Oh, I owed money last year, my taxes, because I made more money." Well, that's not necessarily the case. Like just making more money doesn't mean that you're going to pay more tax through the year, but it doesn't mean that you'll owe money when you do your tax return in the spring, because the employer is supposed to be taking more tax off throughout the year because you were making more money.
So talk to me about TD1 then. What is
Right.
TD1? It's
Right.
not the bank, it's something
Right.
else.
Right. And I guess if we kind of jump back like half a step there, you were saying how basically like your employer, like most companies these days, use an outside payroll service where there are experts in the field. They have, fancy computer programs with all these tables where it's saying, we expect that we're going to pay Ian X number of dollars throughout the year. And based on that, his average tax rate is whatever, right? And so we're going to take off little pieces along the way, and it would get adjusted throughout the year if it clearly becomes different. In most cases, for somebody who has one job, no special credits or deductions, their income is consistent throughout the year, that's going to work out to be pretty much break even, either having a small refund or a small balance owing. What changes things and causes people to either not be having enough tax taken off or getting a big refund is when there's extra variables that get introduced into the equation, special credits and deductions. So you asked a moment ago about the Td1 form. So this is a form that you can fill out with your employer to say, here's additional information that maybe you don't know about, Doug. So I've got an example of it right here.
Let's put it up on screen. Yeah. What is a TD1 and what's on it?
So it's a form from Canada Revenue Agency, 2 pages. On page 1, it has a list of all these different tax credits that you might be entitled to. So it has there's a basic personal amount that we all are entitled to, and it's a credit against your taxes. But then there's all these other ones that some people get and some people don't get. If you're a certain age, if you're older, if you receive pension income, tuition credits for post-secondary education. There's a disability tax credit. If you have a spouse who has little or no income, you can basically claim that person as a dependent. If you don't have a spouse, but you have a dependent child, you can claim that person as a dependent. So it's kind of like saying, here's these special credits that I'm entitled to that maybe you didn't know about. So, tell the payroll company that I'm entitled to these things and put that into the formula, and then they can legally be allowed to take less tax off my paycheck.
Yeah. So if I have, 12 kids that I'm getting a deduction for, that will reduce my taxes. So I can say to my employer, hey, take less tax off my paycheck because I'm not going to owe it at next year when I file my taxes. So a TD1 form, if you're an employee, is, I guess, something you should fill out whenever there is a change.
Right. So, standard procedure would be when you start as a new employee at a company, part of the process when you're meeting with the HR person.
They call it onboarding now.
Oh, I'm sorry.
Onboarding.
Thank you, Mr.
Onboarding.
Okay.
Yes, I had not heard of that either.
You say that, I've heard of that, but you know what? Whatever.
Yeah. So during the onboarding process,
thank you. The millennials will understand this now. Okay.
Have you fill out the TD1?
Right. So you fill out the TD1 form, but maybe that was years and years ago, right? Maybe I was a single guy when I filled out my TD1 form, but now I'm married. Now I have children. Maybe there's some new credits that should be taken into account in calculating my tax deduction. And it's important to understand that, when it's all said and done, when you do your tax return in March or April, it's going to work out to be the same. The information is what it is. But the benefit of filling out the TD1 form is so that there's less tax taken off throughout the year from your paychecks so that you have that money available to you sooner rather than through a tax refund so that you have it to pay your bills, pay down debts. If those aren't, if money is more flexible, you can invest that money throughout the year rather than having a big tax refund in the spring next year.
Well, and this is, I guess, the central question. And just before we finish up on the TD1, on page 2, there is a section that says, hey, I can just have more tax. I don't have any deductions. I don't have any of those things you mentioned, but I would like you to take more tax off. They can just do it.
Right. And that's where we won't get into the technicalities here, but there is a bit of a difference in terms of the tax calculation between a credit and a deduction. So the first page here of the TD1, they're all credits. And then page 2 is saying, here's some other information, some things that are pretty unique that you wouldn't see very often. But there's this one specific part right here that says, you know what? It's telling the employer, I've got something else going on. I've got extra income either from investments or a second job, and I know there's not enough tax taken off. So please take off X number of dollars. I've done my own calculation. I want you to take off an extra $200 from every pay to protect me from having money owing.
Okay, so let's talk about that because there's 2 scenarios. One scenario is I'm going to owe a lot next year. The other scenario is I'm going to get a big refund next year. So we've been talking about, well, if I'm going to be getting a big refund, maybe I should just pay less taxes going on. But I could owe a bunch of money next year that I wasn't expecting. So what are the reasons that an employee could owe more next year than they thought? So you gave one example there, which is I have a part-time job. Right. So, but my part-time job is also taking tax off. How does this cause a problem?
So let's interject there. So on the second, the smaller, the part-time job, they would have their own payroll service that would be doing their own calculation that says, okay, Ian works here. They don't know about my other job, right? So they're just looking at their job where I'm working, say, part-time, 10 hours a week. And based on that, there's a very, very small amount of tax that has to be deducted. But they're doing that. They're following all the regulations. But at the end of the year, when you do your tax return, you're reporting all your income from all sources. And there's a calculation that says based on your total income, here's the amount of tax that you have to pay. So even if that second job in isolation on its own is doing it properly, if that was the only information, in the grand scheme of things, when you look at all the income together, I should have had more tax coming off that second paycheck.
Yeah, because my first job knows I'm making this much money. And for those listening on radio, I'm holding my fingers up. They know I'm making this much money for the year, which puts me in the 20% tax bracket.
Yeah, just make up a number. Say it's 20%.
Right. And the second job knows I'm making this much, smaller number, which puts me in the 10% bracket. So they only took off 10%. But when you add those two jobs together, now my income might put me in the 25% tax bracket.
Right.
So both of them should have taken off more. And I just made up those tax brackets. I don't know if they actually exist or not.
Let's keep it simple for me.
Keep it simple. There you go. So that would be one obvious reason why you will owe more taxes next year. You're working multiple jobs and they don't know about each other, puts you into a higher tax bracket. What are other reasons that I could owe more taxes next year than I expect?
Right. So a very common one that I see is people pulling money out of an Rrsp. Right. So with an Rrsp, we've talked about this many times before.
Registered Retirement Savings Plan.
So when I put money into my Rrsp, I get a deduction on my tax. So I get a benefit now. And the idea is that I'm going to wait until I'm old and gray, I'm retired, I'll wait until I'm 65, 70, and then I'll pull the money out and I'll pay tax on it then. That's not always the way it works, right? So sometimes, much sooner than retirement.
Well, let's say there's a global pandemic or something,
just
and I lose my job. I'm just making stuff up here, but I need some money. So I go to the bank or wherever my RSP is, and I say, hey, can you give me some money? They're going to take some tax off it, but maybe not enough.
Exactly. And that's where it can get really tricky, because there are regulations that say, by law, how much, it's called withholding tax, how much tax they're required to deduct before they pay it to you. And there's actually a scale. So I double checked this because I didn't want to look like a total buffoon, Doug. So if I pull out up to $5,000 from my RSP, the bank or the insurance company is going to withhold 10%. Between $5,000 and $15,000, they're going to withhold 20%. If I take out more than $15,000, they're going to withhold 30%. So let's throw out a scenario there. So let's say you've got, Joe Smith, who has, full-time job, makes roughly $50,000 a year before tax. Well, his marginal tax rate is going to be somewhere around 30%. If he pulls $5,000 out of his RRSP, the bank's going to withhold 10% or $500, give him a check for $4,500. But then at the end of the year, in April, when he does his tax return, his actual tax rate on that $5,000 of extra income is actually 30%. So they should have withheld 30% of 5,000 is $1,500. So they should have withheld $1,500, but they only took off $5,000. So he's going to owe, based on that one transaction alone, he's going to owe another $1,000 on his taxes.
Yeah, that he wasn't expecting. So, and that's a very common scenario. And in fact, your friendly neighborhood banker or investment advisor might say, "Oh, I'll do you a favor here." You know what I'm saying?
Yeah.
Yeah. You want to take out $10,000? Let's do it in 2 tranches.
Right.
Take 5,000 out today and take 5,000 out tomorrow.
Right. I'm going to do you a favor.
Right.
And that way, if we do 2 transactions of $5,000 each, I can limit it to 10% on each. So I'm going to save you money. So basically double what we just said. So you've got 2 checks for $4,500 each, $9,000. But then the scenario we described a minute ago said, okay, from one of those transactions, you're going to owe $1,000. But the favor that the banker just did ends up with a $2,000 tax debt next year.
Right. It's a favor because I have more cash in my pocket today, but I've kicked the can down the road. I've got a much bigger tax liability next year.
And sometimes it truly is, like, sometimes people genuinely know what we just talked about. They know it's not good, but they feel the real...
Well, I need the money today.
Exactly. I feel the desperate need for money today, so I'm going to kick the issue down the road. I'll try to sort it out next year. Hopefully things get better. But other people don't know. Like, other people genuinely don't know what we just described, and it becomes as a big surprise for them when they owe money on the tax return, and they just don't understand why. I never owe money on my taxes. What's different this year?
Yep. Well, you took money out of your RSP. So, yeah, and that's exactly why we're doing the show, so people can sort of think ahead and see what potentially could come up. Now, Another thing I see fairly frequently, not as frequently as the RSP, but still fairly frequently, is I retired during the year. So I was getting employment income for the first half of the year, and then I started getting pension income for the second half of the year. How could that muck up my taxes next year?
Yeah. So with pensions, typically there's a very low, if any, tax being deducted from it. So things like a work pension from your employer would probably be fine. They're going to follow the same rules as employment income. It's the government pensions. Things
so like OAS, for
exactly,
example.
CPP, OAS. If you don't voluntarily have money coming off that, sometimes it's like literally nothing. So I feel like this is like the third or fourth time I've said this. So then at the end of the year, when you do your tax return and you're reporting all your income from all sources, your employment income where you have the T4 for the first part of the year, maybe that part is fine, right? That they withheld the right amount of tax. But then for the final part of the year, you've got a few $1,000s of pension income where maybe no tax came off. And so, it could be any number of different rates on it. But yeah, if you don't have any tax coming off, there's a good chance you're going to owe some money on that.
So anytime there's a change, be careful. I guess the other example I can think about would be if one of my kids ages out.
Right.
Now, does that affect, so let's say my kid turns 18, for example. So that's definitely going to affect the child tax benefit. Is that what they call it?
Canada Child Benefit. Right. Child Benefit.
Canada Child Benefit. They change the names all the time. I can't keep up. Of course, I don't even call it CRA still. I call it Revenue Canada because I think it's still 1950.
Well, there's also the short-lived CCRA from the 90s.
Which is something different again. So, okay, my kid turns 18 during the year, so my child, what did you call it?
Canada Child Benefit.
Canada Child Benefit, what we used to call baby bonus, that stops.
Right.
But I also don't have a deduction for the kid either.
Right. So the Canada Child Benefit doesn't have a direct impact on owing money or not on your taxes. But there are situations where you have a child under the age of 18 that might entitle to other deductions or credits that are no longer available to you.
So again, any kind of change, it's going to potentially affect your taxes.
Right. Well, when we were talking earlier about the Td1 form, I think the way we were talking about it was saying, here's new credits that I'm entitled to, so therefore take off less tax. But really what we just said, it's kind of the opposite. I used to get this credit that I no longer am entitled to, so please take off more tax going forward.
Right. My kid is now older or whatever else has changed. Right. So, and it comes down to the fundamental question, do you want to have more cash in your pocket today or do you want to owe less tomorrow?
And that's a tricky one.
It's a tricky one.
Right, because there are really hardcore investment advisors out there who will tell you that a tax refund is poor tax planning, right? Because it's important to understand, like, really, what the heck is a tax refund, right? So I've said people will quite often use the words tax return and tax refund interchangeably, but if I put on like my tax nerd hat, I'll say no, that's not correct. The tax return is the information. The return is the form that you fill out that says, here's who I am and my marital status and my income and my credits and my deductions. And then based on that, you have either a refund or a balance owing. A refund is basically saying whether it was the RSP deduction like we talked about, or your employer with the payroll deductions every 2 weeks or every week or whatever, basically too much tax got taken off. So here you go, Doug. Here's a tax refund, but it's giving your money back to you.
Right. That's the key point. A tax refund is your money returned to you.
Right. So the tax planner would say, geez, the guy who got a $5,000 tax refund, he should have done better planning, right? He should have, within the rules. The framework that we've been talking about, I should have had more tax coming off every month, and I could have had that money working for me throughout the year, paying down debts, investing, whatever. So, that $5,000 windfall that I got in April, that's poor tax planning.
Right. And sure, I guess in theory, the ideal situation is you get a $1 refund because that way you planned it absolutely perfectly. Right. It's the old saying, when you die, you want to have one bottle of wine in your wine cellar, not 1,000.
Can't take it with you.
Can't take it with you. But that's math, and I agree. As accountants, that's what we would say. That's what the numbers are.
And what I was going to say is, like, for the average person, what we just described, it's not practical, right? And it's not the mindset for a lot of people. So I think more people, they want to have the comfort that I don't owe money to the government. So most people, if they understand these things that we've talked about and they're recognizing it in time, most people will err on the side of caution and take some comfort to having a refund as opposed to the uncertainty of owing money to the government.
Yeah, in fact, there are people who take it a step further than that and say, you know what, I want to have a refund. It's a forced savings plan for me.
Right, exactly.
So I don't mind if, in fact, I may even tell my employer to take an extra $100 a month off me because then I know next March, April, May, June, when I get my refund, there will be a refund there. I won't owe anything.
I've met with, over the years working here, I've met with an example that really stands out is a pensioner, right? Somebody who has very limited income, like literally their only income is Canada Pension, Old Age Security, where their total income of the year is fairly modest so that they really don't have to pay any tax for the year. But they still say to Service Canada, please deduct $100. So I remember saying to this particular woman a few years ago, Mildred, why are you doing that? And she said, it's savings for me. I know what you're saying, Ian. Like I'm not a dum-dum, right? I know I don't have to pay tax, but that way I get a $1,200 refund in April, and it's easy for me. It's just easy, and then I always have plans for that money.
Yeah, and there are a lot of people, particularly parents, who say, okay, well, that refund is going to be used for, the spring clothes, the summer clothes for my kid. It's going to be used towards our summer vacation. So it is an actual savings plan. And from a financial planner's point of view, it's a bad idea to be giving the government money, and they're not paying you interest on it. They don't give you an interest on your refund. So it would be better to at least have that money in a savings account or something where you can earn some interest.
Theoretically, yeah.
The counter argument is, how much do you earn on a savings account today?
Right. So for the average person, the lost interest on that is so minimal that if you try to compare that loss, the opportunity cost of my foregone interest compared to the peace of mind I have from not owing money,
it's kind of a no-brainer. And we're talking about a number of months, not a number of years. Right. So on average, maybe it's 6 months that the government has your money before they give it to you. So yeah, if you're a brilliant investor, and I know you're huge in the cryptocurrency market, always investing
secrets, Doug.
In that new coin that nobody has heard of that will double tomorrow because we read it on the internet.
My proprietary information.
Yes, your proprietary information. Yeah. If you sign up for my newsletter, I'll tell you what cryptos are going to go up. Yeah. That's where obviously you can get into a lot of trouble by, I'll reduce my tax withholdings, use that to do some risky investment, and then not only will I lose my investment, but I want to tax it.
I don't see a lot of people who have a real appetite for that kind of mindset. That seems
crazy. Yeah. But I think, yes, what the financial advisors tell you is correct. If you reduce your tax, if you reduce your tax withholding so your paycheck is bigger, within the law, of course, then I guess you could be contributing monthly to your RSP with that extra money.
Have it working for you sooner.
Have it working for you sooner, generating a tax return refund sooner as well. But I also agree with the forced savings plan. If that is what is right for you, if that's how your mind works, if you're worried that, hey, if I have that money, I have the best intentions, but I'll probably spend it, then the forced savings plan is an excellent idea.
So it's really important to, I think, educate yourself, but then also, part of that education process is knowing yourself and your history and your tendencies.
Yeah. So if you think there's any risk that you're going to spend the money, then giving it to the government for safekeeping isn't a bad idea. And, having a plan for what you're going to do with that money when you get it for your refund is a good idea. Now, this show is called Debt Free in 30. So let's address two debt topics. First one is, if I have a bunch of credit card debt or payday loan debt, then under that scenario, I'd be arguing that, you probably want to be paying as little tax as you can throughout the year because that extra money on your paycheck could be used to pay down a very high interest rate debt.
Because that, we talked about how, if you're putting that extra money into a low interest savings, that's not a huge benefit. But if you're paying down high interest debt, absolutely, that's going to save you a lot of money.
If my credit card interest rate is 20%, then by paying it off early, I'm earning 20% after tax.
Right, you're effectively earning 20%.
Right. And if my marginal tax rate is 50%, I just earned 40% after tax then, I guess. So that would be a prudent example where not paying as much tax going, each month is good to throw it against the debts. Now, we're going to talk one more question about debt, but before I forget, we've been talking about as an employee, I want to withhold, we adjust my withholdings. If I'm self-employed, there are no withholdings.
Right.
So in that case, it's not a question of filling out a TD1. I guess it's as simple as, well, every month you should be sending something to CRA.
Right. So if you have a history of owing money for different reasons, with self-employment being the most common one, legally you're supposed to be making installments to the government every 3 months. And I'm sure you've seen that many times over the years. A client gives you this installment reminder from CRA and says, "What the heck is this, Doug?" Mm-hmm. So many people don't understand what that is. But yeah, at minimum, you should be putting it into your own bank account so that you have it saved up throughout the year. But more ideally, you actually make an installment payment to the government every month or every 3 months.
Yeah, the law may say you have to do it every 3 months. I'm a big believer in every time you get paid, if you're self-employed, you get, bill your general contractor because you're in construction twice a month. Great. Twice a month, you know that you're in the 30% tax bracket.
Yeah.
So take 30% of whatever you've got, go online to your banking, send it to CRA.
Make an installment. I agree. The money's there.
And you can't get into trouble then. Now, final point on debt, and that's, if you go bankrupt, the rules are somewhat different. And we're not going to do 40 minutes on a bankruptcy tax return here because it's complicated. But
and very exciting too.
And exciting, yeah. We'd lose all our listeners. But here's the 10-second version. When you go bankrupt, as you know, there are 2 tax returns in the year of bankruptcy that the trustee has to file. So if you file bankruptcy on this date, there's a tax return from January 1st to the date of bankruptcy, and then another one from the date of bankruptcy to the end of the year to put you back on the same schedule as everyone else.
Right.
If you owe money up to the date of bankruptcy, it's included the bankruptcy.
Right, because it relates to the time period prior to the date of bankruptcy.
So conceptually very simple. Now, if you owe money from the date of bankruptcy forward for the rest of your life, well, you've got to pay it.
Right, just like any other new debt.
Like anybody else. So if you are bankrupt, and you tell me if you agree or disagree with this statement. If you are bankrupt, it does not make sense to be paying extra on your taxes each month during that post-bankruptcy period. So I'm talking about from the date of bankruptcy to the end of the year, because if that generates a tax refund, it's going to the trustee for your creditors, not to you.
Right. Yeah. So you're highlighting, there's a part of the bankruptcy legislation that says the refunds from that year of bankruptcy, they don't get paid to the bankrupt individual. They get paid to the trustee, goes into the estate, the pool of money, and gets basically divided amongst the different creditors. So you wouldn't be. I guess everybody's trying to strike that right balance. Trying to get that that break even point. But if clearly the scenario, Mildred, to whom I referred a few minutes ago, the pensioner who clearly won't owe any money and has this history of like the kind of forced savings like we talked about, for her, absolutely don't do it, right? Don't keep on with that deduction every month, because you're going to lose that money, and there was no other way you're going to lose that money. But the self-employed person, you want to be paying something towards it because you don't want to have a new tax debt that's accruing while you're still in bankruptcy, but you don't want to overpay it at the same time. So it's really trying to strike the right balance.
Yeah, which is why when we're doing a bankruptcy for someone, we'll get out our pen, or in your case, a computer, because you know how to work those things, and we'll do a quick calculation and say, yeah, you know what, you should probably make sure you continue to send this much each month.
Right, exactly.
Not this much, but this much, and you should be good. So, okay, last question. Practical advice. So what is the advice you give someone when they are trying to think through this decision about, should I have more taken off? Should I have less taken off? How do you guide someone through that decision?
Well, I think we already touched on that in a way a few minutes ago, where it's just talking to the person, asking some open-ended questions to identify how do they feel about it. Right? The idea of, well, even part of it is identifying, are there factors that have the possibility of leading to a balance owing? If the answer is no, if there is no second job, if there is no small business with no tax withholding, I would say to that person, unless there's a compelling reason to do this forced savings plan, your normal payroll deduction through work, you're going to be fine. You're going to be a very small refund or a very small balance owing. So I think it's trying to give the quick version of our show here today to walk through these different considerations so the person can reflect on it, think about themselves, and we can have some back and forth to identify what is the priority for that particular person. Right.
So I agree with you. You start with the psychology of it, and then the math of it is, okay, how much do you think you're going to owe next year? Mm-hmm. And if you're still working at the same job, making roughly the same amount of money, it's pretty easy. Take a look at last year's tax return. It'll probably be pretty accurate. If something has changed, I always tell clients, well, if you do your taxes yourself, pull up last year's tax return because next year's isn't out yet.
Right.
Just change the number.
Right.
Okay.
And then the rates will be pretty much
close.
the same. Right.
It'll be close. I mean, obviously we've gone through an election and everything, but I don't know that it's going to change anything. So, okay. Last year I made $35,000. This year I think I'm going to make $40,000. Type the numbers in. Right. Okay, if I'm an employee, it's probably all going to work out anyways. But if I'm self-employed or if anything's changed, well, punch in those numbers, see what it comes up to. There's lots of online tax calculators too.
Right. Well, I was telling you before we started recording, I was telling you about an example of a guy that I met with last week where he filed bankruptcy with me back a few months ago. So he has income from, he's retired now, but he has his pension through the union. He also receives a disability payment. And he has a variety of other debts, but every year his income is very consistent. It's not going to change. And pretty much every year he owes roughly $3,000 a month or $3,000 a year for the tax. So I talked to him and said, well, here's why. Here's why that's happening. And I helped him fill out the Td1 form where, again, his income is very predictable. So if you take $3,000 divided by 12 months, that's $250 a month. So I helped him fill out the Td1 form so that he has $250 per month coming off his pensions, just so that he won't be surprised. He doesn't want to be coming out of his bankruptcy and owing another $3,000 on his taxes.
You always want to be ahead of it. So, and I think you're right. That's the summary of the show right there. Look forward, estimate it, and make sure you're having the correct amount taken off. Ian, thank you very much. Any final comments, or did we nail it?
As always, Doug, I think we nailed it.
We think we nailed it. There you go. Well, you could put your
I was going to say the viewers will
put the comment on you or on YouTube and tell us. So we are recording this show in the fall of 2021, and normally we talk about taxes in April because that's when tax filing season is.
It's on people's minds then.
Yes, and so if you go back to YouTube on the channel and punch in Ian Martin's name, you'll see we've had him on lots of times in that time period. So either we're talking about taxes 6 months early or 6 months late, depending on your perspective.
Right.
I wanted to do the show now because I think you've still got time if you think you're going to owe money for this tax year to increase your withholdings for the last 2-3 months of the year so that next year you don't get hit with as big a tax liability.
Right. And really the tax man's going to get you now or later. So doing, it's like September 2021 right now. So doing your tax planning for your 2021 tax year in April of 2022, it's too late.
Yeah, it's too late.
It's too late, right? You're going to do your return. So you want to, if you're concerned about it, you want to take some time now, educate yourself, maybe talk to a tax planner, and you still have some time to make some adjustments to hopefully mitigate the risk of a balance.
Yeah, you want to do it as early as possible.
Absolutely.
And I think the 2021 tax year will be a difficult one for many because for most of this year, CRA has been relatively benign with respect to their collection activities. We know that in the year 2020, 9 million Canadians got CERB, which did not have any tax withholdings at source.
Right.
So a lot of people owed taxes for 2020. CRA said, hey, you know what? We're still in a pandemic. We're not going to bother you too much.
Right. So they came out with a fairly official policy statement back in, March or April, whatever, saying there's conditions. If you owe money on your 2020 taxes and you meet certain conditions, including receiving some kind of COVID-related benefit, they're giving you an extra year to pay that back, meaning they're not going to add interest or do any kind of collections until April of 2022. But that's coming, right? Yeah.
By April 2022, I will have my 2020 tax year and my 2021 tax year, which may also have implications.
Yeah.
So you really do want to be getting ahead of this because there will be a lot of Canadians in 2022 who may end up with 2 years worth of tax liability. Right. And once you get too far behind, it's really hard to catch up.
It kind of snowballs.
And that's not a good thing. So that's the message today. Look ahead and start preparing. And if you are in a position where you already owe a ton of money in taxes and other debts, well, obviously you're going to be giving us a call and we'll walk you through the options on that because unbeknownst to a lot of people, yes, income tax debts are dischargeable. They do go away if you file a bankruptcy or a consumer proposal.
Absolutely. It's a very common misconception.
And so it's federal law. CRA has to follow federal law as well. Ian, thanks very much for being here.
Well, thanks for having me, Doug.
Thank you. That is our show for today. As always, please like, subscribe, hit the buttons and all that stuff on YouTube, and leave a comment. Always happy to hear from you. Until next week, thanks for listening. I'm Doug Hoyes. For Ian Martin, that was Debt Free in 30.